Thank you very much for coming in tonight. My name is Rich Boehm. I'm your host. I do appreciate you taking the time. I know most of you would rather be home watching reruns of Roseanne. We've got quite an exciting topic tonight, the Secure Act. It really does, as Susan mentioned, impact pretty much everyone. If you have a retirement plan, an IRA, any type of qualified plan, and if you file taxes, the Secure Act really does have some form of an impact on you. So realize I am a certified financial planner. I work with families and business owners. I help people to pay less taxes and make more money so that they can spend time on what matters most to them. And that's what we're all about. And when you look at this and when you look at financial advice today, a lot of what my foundation is built on, I love this quote by Robert Kiyosaki. It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for, okay? And it really says a lot because today when people typically get financial advice, I find that people look really and only see one area. What is everyone normally focused on? Returns, or most importantly, investments, right? So the reality is, when I got into the business 26 years ago, I was doing income tax returns. And why I do what I do is because I sat and I was doing income tax returns, and I found that people would pay me a fee to do their taxes. They would then go to an insurance agent to buy their life insurance or disability policy. They'd go to an estate planning attorney to get their wills or trusts done. They might get some retirement information, and then they'd go to an investment person or investment manager to put together some type of investment strategy or asset allocation. So everyone here is getting paid all these fees, and the one thing I noticed is that no one was ever talking to each other. And I'll never forget where I sat with this woman, and she had these transactions, and it cost her to pay an extra $10,000 in taxes. And I just quick looked at a couple things. I said, you realize, but we could have made two little changes, two quick changes. We could have wiped out that entire tax. Didn't your advisor bring that up to you? And the answer, of course, was what? No. So I always ask you, how many people have an advisor that even looks at their tax return? Probably never. Leaves my client. Okay. Now, if you think about it, every decision we make financially, we have a partner in this world called the IRS. So every financial decision you make has a tax consequence, right? So how in the world are you getting a true holistic, the best advice possible if no one's even looking at your tax returns? And the answer is probably you're not. And that's what I found is all these important people, if you think about it, all these important people in your life other than your family and your health, okay, they never even speak to each other. And who do you think that hurts? Okay? So we has developed, and again, I saw this with my own family. When I was younger and I first started, I was only 22 years old when I started in the business, my grandfather actually came to me. He had gotten sick. He worked construction and then wound up running the union in New York City, but he got asbestos poisoning in his lungs, and he knew he had a limited time. And he was very concerned because he saw a friend of mine lose a house on Nantucket because when his grandmother had passed away, they didn't have the right planning in place, and they had to sell the house in order to pay the taxes. And he said, I don't want that happening. And he said, I need you because for some reason he trusted me more than my brother, my sister, even my father, and my aunt to really take a look at everything that's going on with their finances, because the other part of it was my grandmother knew nothing. She knew she got a dividend check and she could write us pizza money when we went to college, okay? He wanted to make sure everything was taken care of. So what I discovered, even working with my own family, was that, wow, no one looking at the big picture, no one bringing it all together. Look at all the gaps, look at the mistakes that could be made. And I wanted to make sure that none of my family, none of my clients ever experienced that. So what we have done as a firm is really taken a look, and we've brought these key areas together under one roof, where we have, as I said, I'm a certified financial planning professional, so we're a fiduciary, which means that we have to put, by law, the interests of our clients first. Now you think, when it comes to money, that advisors have to put your interests first, don't you? Right? The answer is not true, though. Not every advisor has to put your interests first. They don't have a fiduciary standard. which means they can just do what's suitable. It's kind of like going to Brooks Brothers. They tell you, hey, you want a suit? Here it is. It doesn't matter if it fits you or not. It just, it's a suit. It's suitable. Where we have to make sure that it's the right fit, it's the right color, it's the right thing for you, okay? And again, we have a team approach at our firm where we really have a collaboration with our clients and our team to get a deep understanding of what are your whys. What matters most to you? Why does it matter? Because that's how we're going to get you to where you want to go. And again, not look at you in pieces, but look at you as a whole. And we accomplish this through our UWM True Bearing Roadmap. Okay? So again, for us, we're looking to answer two big fundamental questions. The first one, are we going to make it? And that translates to, am I ever going to run out of money before I run out? Okay? I can tell you that 99% of my clients, it's their number one concern. Am I going to make it? Am I going to run out of money? The second thing is, do I have any financial blind spots? Because I will tell you, what you don't know can hurt you. And not knowing some of these things that are out there and some of these blind spots, and you're going to see in this Secure Act, there's some big, big changes that really impact you. You need to have a good understanding of what everything looks like and have someone who can bring it together. That's why we love helping people make informed decisions. But again, if they're not looking at your whole picture, how in the world can you have that? So the whole picture does matter. All right, so that's a little bit about us and how we do things. Tonight, again, we look at the 5 key areas of financial planning: protection, retirement, investments, tax planning, estate planning. The Secure Act really directly impacts 3 of these main areas. It impacts tax planning, retirement planning, and your estate plan. And let me ask you this. Tax planning is a big one in this area. How many people find the tax code confusing? Anyone? I mean, look at this. For purposes of paragraph 3, an organization described in paragraph 2 shall be deemed to include an organization described in section 501c, 4, 5, or 6, which would best be described in paragraph G if it were an organization described in section 501c3. Got that? That's the actual tax code. And I got news for you. It's huge because it's meant to be complicated, and it is complicated. Okay? So we want to make sure we help you to navigate these things, and that's what we're here. So again, the Secure Act is the Setting Every Community Up for Retirement Act. The number one purpose behind this legislation is that people are not saving enough money for retirement. That was the number one purpose behind this legislation. In fact, what they found is over 53% of businesses in America today do not even provide a financial plan or, a retirement plan option for their employees. Okay? So the number one thing they were trying to do here is how can we make it easier for people to save? Can we give them more options? Can we make it more cost effective? How can we incentivize business owners to actually set up plans? And how can we make it easier for them? Okay? In a lot of ways, it does those things. And then it has some repercussions of some after effects that people were not maybe aware of. Okay? So it definitely expanded retirement plan access and saving opportunities. It modified the required minimum distribution rules for retirement plans. And one of the big things it provides is that every plan that is issued must now contain a lifetime annuity option, meaning they have to give you a choice within your retirement plan that you can convert those dollars into a guaranteed lifetime income. Okay? One of the biggest changes. So in terms of retirement savings, okay, there's a lot of different types of accounts out there. There's pension plans, profit sharing, 401k, ESOPs, KIOs, 403bs. The key here is there's a lot of different types of plans, and although they seem similar, they all have their own separate rules, and they have all their own separate way of doing things, okay? So the big thing here is, number one, the Secure Act actually expanded the ability for people to save for retirement. On the individual level, really interesting here, a lot of our Americans today are aging, and they're continuing to work. Under the old law, when you turned age 70 and 70 and a half, you could no longer contribute to an IRA and get a tax deduction. Is everyone aware of that? Okay. All right. One of the new things, you can now continue to work. If you have earned income, even if you're over age 70 and a half, you can now contribute to an IRA account and get a tax deduction. If you have a spouse who is a non-working spouse, you can also make a contribution to his or her IRA, even though they're over age 70, and get a tax deduction. Okay? You got to see if that makes sense. They bumped up the automatic, in plans, they make the automatic maximum contribution is increased to 15%. So the way the law reads, it's a maximum of 15%, the lesser of your 15% of your salary, or a maximum of $19,000 in tax year 19, and there's a $6,000 catch-up provision. So anyone who's over 50 and older can put away $25,000 into a 401k plan, a solo K, an individual K. All right? And again, here's the big thing for workers that we really need to figure out is starting in 2021, what are considered long-term part-time workers are now eligible to participate in the 401k plan. So these people who are always excluded out are now going to have the ability to contribute to a plan, which is good, good, good. Okay? And again, the annuity option is a big thing. So here's one of those incentives in order for the business owner who doesn't have a plan. Before this act was passed, they used to give you a $500 tax credit if you established a new plan. Now, a tax credit is really powerful because a tax credit dollar for dollar reduces your actual tax liability. So if I have $5,000 of taxes and I have a $5,000 tax credit, how much in tax do I pay? Zero. It's very different than a deduction. If I have a $5,000 deduction, I may only have maybe $1,000 saved in taxes. It's based on my bracket. So a tax credit is very powerful. One of the cherries on top of what they've done here is that now there are tax credits available that may go up to as much as $5,000 in tax credits for the cost of setting up a new plan. In fact, if you add the automatic enrollment provision to the plan, they will in fact give you a $500 per year credit for 3 years as well. Okay? You can save. So big tax available. Again, it's to establish a 401k, 403b, SEP IRA, simple IRA, pension plans. So again, employers may adopt the funded up to the due date of the employer's tax return. So you have some of these plans are available to set up for 2019 still. You still have until you file your corporate returns or your personal returns. Correct. Here's the other big one. This is called multiple employer plans, Meps. This goes into account, or this goes into effect in 2021. What they're basically here going to allow you to do is all small employers, businesses can now pool their resources and all join one plan or create one plan, one 401k or one type of retirement plan. So the advantage there is you don't have to be in the same industry. It can be different industries across the board. But the big thing is it creates a nice economy of scale where multiple businesses share in all the costs, which lowers the participant cost as well as the employer cost too. So that's a pretty powerful thing. Okay? Now, a lot of people in our industry are very good, I think, at the first phase of retirement planning, which I call the accumulation phase. Where we see a lack of true expertise, a lack of experience, a lack of real know-how, is in what I think is the most important phase, or could be the most important phase, which is retirement distribution planning. Retirement distribution planning is complicated. And the reason it's complicated is because there's really 3 areas that really intersect or intertwine when it comes to retirement distribution planning. You have tax planning, retirement planning, and estate planning. Okay? And our number one goal is for our clients, we want to make the money last as long as you do. We want that money to pay the least amount of taxes, the least amount of expenses. We want it to go to who you want, the way you want, and most importantly, with the least amount of headaches. And that presents a real challenge in distribution planning. Now, why it's important is that one of the big changes with this law prior to the Secure Act was how the the individual tax rates themselves were set up. If you look back in 2017, the highest tax rate was 39.6%. In fact, it's even higher because if you had more than $250,000 of income, you could also be subject to what's called the net II, or net investment income tax, which is an additional 3.8%. Okay? The next bracket was 35, 33, 28, 25, 15, and 10. With the new change in the tax law with the Jobs Act, the highest bracket is now at 37%, but you can see more income falls in these lower brackets now than ever before. Okay? One of the keys that we want to look at from a planning perspective is how can we maximize utilizing these low rates, and they are historically low tax rates, while they exist. Because I want you to understand this is a small window of opportunity that is available to people. Because the reality is these tax laws sunset, meaning they go away in 2025. Okay? Now, we were talking to our planning team yesterday, and they even brought up, think about it. A year ago, the United States had one of the highest corporate tax rates at 35%. They then brought it down to 21%, right? But as a consequence, what do you hear about a lot in the news now? Deficit and Amazon not paying any taxes. Such and such company paying zero taxes. Our feeling is these low tax rates are not going to be around. When you add another $1 trillion in deficit, okay, the reality is we feel very strongly that most likely, doesn't matter, not even being political, tax rates in the future are going to go up. You want to make sure you're using and being able to maximize the use of these brackets right here. And that has a lot to do also with business owners who are pass-through entities or C Corps, because again, you get that 20% right now. We have that QBI deduction, qualified business income deduction. That's something that could go away. 21% could go away.
So the sunset in 2025, that's not for the corporate tax rate?
Correct. Just not on the C Corps, just on individuals. And the QBI.
So it would take actually a law to change theirs, but ours will go automatically.
Correct. So if you're a pass-through entity, a Schedule C, an S corporation, right, a partnership, LLC, you're not going to, they have to change the law in order to go back. So the reality is, our feeling is, we think rates are going to go up, which is why it's really important to understand how the Secure Act now also impacts distribution planning and how you handle your assets. Because one thing that I always remind people is that retirement accounts are different. Retirement accounts are very different than other money. Okay? They have all kinds of their own rules. One of the most important things is retirement accounts distributions are taxed as ordinary income. Now, I will tell you, I've seen it all. There's a lot of confusion. Sometimes this happened. I had a client who said to me, I bought Apple at 30 in my IRA. I'm so excited because it went to 300. It's long term. I'm going to sell it, pull that money out, and I'm only paying 0% tax because I'm in the 12% tax bracket and I get the qualified dividend and qualified capital gains. And I said, oops, no. Capital gain treatment does not exist inside a retirement account. Qualified dividend treatment does not happen inside. Anything that's distributed from a retirement asset is considered ordinary income. Here's another big one. Retirement assets do not pass through your will or your trust. Okay? They pass through a beneficiary form. One of our standard operating procedures and what we do when we bring on new clients is a thorough review of people's beneficiary forms, because we find lots and lots and lots of mistakes here. It's something you want to look into. Just a couple weeks ago, we had a client come in, prospect, had $1 million IRA. Took a look at his beneficiary form. Guess who his primary beneficiary was? Good answers. I would have thought that too. In fact, it was no one. He had no primary beneficiary listed on his account. Based on the federal tax and the state he lived in, that's only a $500,000 mistake. Because what happens in that case is if he died, that money gets paid into his estate. It becomes taxable all on one day at ordinary income tax rates plus the state and city taxes as well. 50% of the money that he saved 20, 30, 40 years, gone. Okay?
Yeah, but he's dead. He doesn't care.
His family did. And his 3 kids. So the other part, another one is big mistake. We did this for one of my clients. His ex-wife was still the primary beneficiary in his account. The other thing to consider, though, too, here is some people have named their trust as the primary beneficiary. Understand that the Secure Act has made significant impact changes on using a trust as the primary beneficiary that you need to review. Very important, okay? It can have a severe negative impact if the trust is not set up and worded properly. The other thing that a lot of people forget about here, they name a primary beneficiary, and what do they forget?
Secondary.
A contingent beneficiary, okay? If you do not name a contingent beneficiary, there is a wealth of planning opportunities you have available to you under the Secure Act and what you can do to avoid something I'm going to show you in a minute. And you need contingent beneficiaries on your account in order to make those planning opportunities exist. If you don't have those contingent beneficiaries, those planning opportunities go out the window. And again, everything you've saved for the last 20, 30, 40 years may pay some of the highest tax rates. Okay? Again, they must follow beneficiary designations. There's no probate on retirement accounts. These beneficiaries, okay? These beneficiary forms override your wills and trust. Okay? Make sure you understand that. And normally what we find is many people have a different plan inside their trust on how they want their money handled than what their beneficiary forms say that is going to happen. Okay? So again, choosing a beneficiary is a big, big deal. Unfortunately, what we have found is one of the biggest beneficiaries of people's retirement accounts is the IRS. In fact, you're going to see a big change in this because of this Secure Act, a huge benefit that gave every IRA owner a significant way, or retirement account owner, a significant way to save taxes for their family over generations is out the window. And the reason they were able to get away with it was because they found less than 2% were using the planning technique. Okay? So again, choosing a beneficiary is very, very important underneath the new laws of the Secure Act. Okay? See, one thing that's happened is the calculation. Everyone has to take out a required minimum distribution from your retirement account when you reach a certain age. One of the things that the Secure Act did is it changed the minimum age from 70 and a half to 72. So you now have an extra 18 months of deferral. And for some people, you can actually break it out to the year you turn 72. You can wait till April 1st of the following year before you take out your required minimum distribution and defer the tax even further. Okay? But there's consequences for that. You got to take a look at it. So there's that. So what I always remind people is, I can tell you, between the ages of 59 and a half to now 72 are some of the most important decision-making time when it comes to your retirement than you will have. It is a time period, it is a small window that gives you the greatest opportunities in order from a planning perspective on how to affect your retirement. And you have to get it right, because these decisions that you make, most of them are irrevocable, meaning they can't ever get changed. So you really have to understand these distribution laws, okay? Now, one thing that they do allow, and they kept this in the law, is at age 70 and a half, you are still allowed to do what are called qualified charitable distributions from your retirement account. Now, what is that? Well, what they allow you to do is literally take up to $100,000 or your RMD and pull it out of your retirement account, donate it directly to a charity, and not pay tax on that income. Now, why is that important? Because First of all, the standard deduction has gone up to $26,600 for most people who are retired or who are at this age. They can't itemize the deductions. So they donate monies to charity and they get zero benefit for it. Okay? Guess what? Here's your new tax deduction. Use your IRA distribution, send it directly to the charity of your choice or the charities of your church. Use that to make your charitable contributions, and now you get a tax deduction even if you don't itemize. And you can still start this at 70.5. So again, it may not affect some of the people in this room, but you may know of people who are in this position, and they should be aware of it. A lot of people are still not aware of this. It's a great way. So again, it's a way to take money out of your IRA account, pass the tax, and not include it as income. So for many people, not including this RMD on their income tax return, they lower tax on their Social Security, they lower tax brackets, they lower their overall tax rate. It can really save them a lot of money, okay?
There's no penalty for withdrawing or anything?
Correct, you just have to be 70.5. You got to make sure that the IRA sends the money directly to the charity. You don't take possession of it first.
IRA only.
Yes, this is for IRAs, okay? So here's, when I say it saves money in taxes, first example, income before is $120,000. You got to pull out $10,000 for your required minimum distribution. So your adjusted gross income is $130,000. We take the $26,600 deduction. $103,400 is your taxable income. In contrast, if you use the qualified charitable distribution instead, $120,000 of income, there's no RMD income. It went to the charity tax-free. $26,600. Your taxable income is $9,400. You now save $2,200 in taxes. Could anyone else use an extra $2,200? Could you do something better with that money than the IRS can? Okay. It's very simple. So what are you able to do? You save taxes and fulfill your charitable obligations all at the same time. Okay. Now, here is one of the absolute biggest consequences and changes of the Secure Act that you need to be aware of. And it has to do with when your IRA is distributed to a non-spousal beneficiary. See, back in the good old days before the Secure Act, if you had an IRA and you passed it on to your children, okay, those kids could set up a special account called an inherited IRA account, and they could defer the taxes on that money and spread them out over their lifetime, their life expectancy. They could then turn around and do the same thing for their children. You effectively could postpone and reduce it 50, 60, 70 years, depending on the beneficiary structure, if you did it properly. See, what a lot of people don't understand is that when you die, if I have a spouse, my spouse can elect what's called a spousal rollover. And that's a tax-free transfer to the spouse's IRA. Now, it's good news, right? The spouse now has the money, your spouse now has the money, and there's no tax. It could also be bad news, like one of my clients. Husband and wife, he dies. He was married prior, had children. She was married prior, had children. His children now have pissed her off. They don't care about her. They upset her. What did she do? Change the beneficiary. Disinherited his kids. All the money goes to hers. Okay? There's ways to avoid that if you do the proper planning. Just be aware, consider those kind of things. Okay? But again, the stretch IRA was great. You could spread out over a life expectancy. And again, you could really do good bracket management. Now, underneath the Secure Act, what they're saying is all retirement accounts, IRAs, 401ks, Roth IRAs, everything, the money has to be out of the account, distributed to the beneficiary in 10 years. Okay? 10 years. This could happen. Go ahead.
Can you do the taxable donations to the charities out of this?
Good question. We're going to get to that, yes.
Are existing inherited IRAs grandfathered in?
Great question. The answer is yes. Yes. So if you've already done the inherited IRA, you're good to go. okay? But if you haven't, we have a 10-year window to deal with. And this is problematic because you have to remember, again, if your advisors aren't even looking at your tax return, they probably don't even understand what tax returns your kids are in, right? What tax brackets. Imagine now, here you are in the 22% bracket, your kids are in the 37% tax bracket. We have some arbitrage there, right? Some good planning you got to take advantage and be aware of. Why would you want your kids to pay at 37% on those dollars versus, say, 22% now, right? Also, when children inherit this money, it may bump them up into a higher tax bracket. It may cause them to go above that $250,000 threshold and make them pay that additional 3.8% net II tax, net investment income tax. It may affect Medicare premiums that people pay. You don't realize that. If you have a lot of income, right, what does Medicare do if you get Medicare payments? If you pay for Medicare, they bump up your. There's lots of consequences to this that people are not aware of. Okay? So again, elimination of the stretch provisions applies to all IRAs and Roth IRAs. And again, there's a few different exceptions. Again, spousal beneficiaries. So we're looking at all kinds of strategies. So remember I told you about naming the beneficiaries. So you look at, hey, does it make sense to give a portion of the money to my spouse? And then if I've got 3 young children, do I then also designate some of those 3 young children? Because here's the good news. If the child is under 18, they get to defer all that time until they reach age of majority, and then they have another 10 years to pull the money out. Okay? So the only thing I'm telling you, I'm just going to point out there are, and all I want you to take away from this is there are strategies that you can take advantage of when it comes to this type of planning. Okay? A big one is Roth IRA. Okay? Anyone familiar with the Roth IRA? Okay. So the beauty of a Roth IRA is that you don't get an upfront tax deduction for putting money in, but as long as you wait 5 years and are over age 59 and a half, all of that money that grows into a Roth IRA comes out completely tax-free. Okay? This is powerful, powerful, powerful. I'll show you how we used it with one of our clients. Okay? I call it the tactical Roth conversion strategy. He's a business owner who has 3 kids, sells his business, he's doing some consulting work, does not need to take money from his accounts for the next 10 years. When he reaches, I think 70, he wants to start taking income at that point, and we expect him, hopefully he'll last into his 80s and so forth. So what we looked at is all the different ramifications that he's got to deal with. When should he take Social Security, right? He doesn't need income now. Should he postpone it? How can we bridge if he needs income? All these kind of things. But most importantly, we looked at what we call tax bracket management. We projected his tax rates for the next 5 to 15 years out. And what we did is we figured out a way to take his IRA account now and tactfully convert it over the next 10 years at a very low tax rate, okay? Because he has no income, right? 10 years goes by, his now 100% of his retirement accounts are now Roth IRA. We looked at the projection. It saved him 35 to 40% in taxes each and every year over his entire retirement from age 70 to 84. Meaning that his projected tax rate was going to be $50,000. It knocked it down to $35,000 and saved him $15,000 a year in taxation. What could you do during retirement with an extra $15,000? What could you do for your family? Could you help fund some education? Could you take some nice trips together? Could we spend more time together as a family? See, I'm all about the time. My clients love time. That's what they want to use it for. They want me to handle everything else. They want the time. But what I can open up for them is the opportunity to spend the time in things that they want to do. That's what we were able to do with that man. Okay? His CPA took a look at it. He's like, my God, this is a phenomenal plan. He gave me a big endorsement, which is very rare for CPAs. They never want to agree with the financial advisor. Okay? So now the other thing is I mentioned he had 3 kids. Okay? If he had died with a traditional IRA, what happens? Those kids now, who are in the 33 to 37% tax bracket would have had to pay taxes on that money at those rates. His rate was what? 22. Huge arbitrage there. So if he makes it to 70, the whole thing's converted. If something happens to him later on down the road, here's the other beautiful thing. His kids pay zero on this money when they inherit it. Isn't that great? Yeah. Little simple strategy, little simple change, okay? So again, we look at these things and you look at it from a lot of perspectives, and here's one of the most important perspectives for you guys or anyone who's a business owner, because you have what is called qualified business income. And if you get that qualified business income deduction, one of the things you have to look at, okay, number one is, how can I maximize my QBI deduction? There are things, there's techniques you can use on how you structure your business, how you structure your entity, how you structure your income that could increase that 20% deduction. And you want to do it now while tax rates are low. And then what we are showing people is, let's set up a 401k plan for your company. We'll get the tax credit for setting it up. I have a specialist, Kristen's in my office. She worked for the second largest 401k provider in the country for 20 plus years, ran a team of 25 people, worked on some of the biggest clients for that firm in the country, knows this type of planning and these type of and 401k plans, okay? We set up that 401k plan, but we do it this way. Instead of setting it up as a traditional 401k plan, we put in a Roth 401k option. See, if you do the numbers, if you're under $315,000 of income and you get just a 20% normal QBI deduction, your effective tax rate comes out to about 19%. That's really low, okay? Remember, the highest tax rates just were 39.6%. So at 19%, that's low. So what we're showing people is, take all of that money now that you can defer and throw as much as you can into that Roth 401k option. And heavily fund it as much as you can while we get this QBI deduction. And tax rates are so low. The numbers are astounding compared to funding a traditional versus that. I don't know if anyone's ever run the numbers for you before, but it can make, depends on your situation, it can make a huge, huge difference, okay? And if you have a really good CPA and a good financial planning team to work with, they have really excellent techniques to maximize that QBI deduction. And remember, we only have about 5 years left of it, okay?
For QBI, can you be an LLC or?
Yes.
You can.
Yes, if you're a pass-through entity, which an LLC is a pass-through entity, okay? So one of the things, I can tell you, one of the things that you look at is, does it make sense to be an LLC or should you be an S-Corp? There's so many different ways that you can look at restructuring yourself to get them to maximize this and really up it and really drive that tax rate down, okay?
So from that standpoint, I'm just curious. A lot of accountants, or a couple of accountants I know, have changed a lot of companies from an LLC to an LLC taxed as an S-Corp. Does that have anything to do with this
Yes.
reason?
That most likely, yes. If they were looking at it from a QBI perspective, because if you're a solo member or single member LLC,
Yes.
you can't pay yourself wages, okay?
Right.
So with a lot of these techniques, there's a lot of background to them. So with an S-Corp, the owner can pay themselves a wage. So by using the technique of using wages, you can increase your QBI deduction, where someone who's a Schedule C or a single member LLC can't.
Okay. Because you've been seeing an uptick.
Yes, correct. But I will tell you, most accountants, I call them, they're like, to me, are like scorekeepers. Okay? You give them the information, they write it down where it belongs on the form. Here's what you owe, or here's what you're getting back. Thanks for coming in, we'll see you next year. Okay? I always tell people, I don't care who prepares your taxes, we're most interested in planning your taxes, because there's opportunities to save tons and tons of money. Another idea, if you're a small business owner, maybe you have no employees, maybe few employees, But I'll tell you a story of a professional we set up a plan for. He was 30-something years old, finally paid off all his debt, his student loans and everything. His business started taking off. He finally had a significant amount of money to start putting away. What we did is we set him up with a defined benefit plan, okay? And the defined benefit plan will provide a pension for the rest of your life. It allowed him to defer a lot more money. But the other thing it allowed him to do is that he had a couple of young kids and a wife, and they had no life insurance. You know what the great thing is? You can buy life insurance through a defined benefit plan. And by the way, you do it with pre-tax dollars. So you get a 40% discount in his case on buying life insurance premiums. So he protected his family. He was able to sock away a whole bunch of money, use the cash value policy. So down the road, there's also a really unknown technique. You can actually transfer that life insurance policy out of the business, and now he'll use it as a secondary income for tax-free income. Okay? So again, utilizing life insurance to maximize your retirement. There's some really great opportunities in there. You want to take a look at. For those people who are charitably inclined, if you've got a bigger estate and your whole idea was, hey, listen, I want to leave 10% of my money to my estate. What we're showing is, hey, look, take the IRA money and use that to go to charity. Because there's no tax on that. The state gets a deduction and no one has to pay tax. You fulfill your obligation that you wanted to do. The kids get much more preferential income or assets.
But that's only after you're 70 years old.
No, we do it in estate plan. This is more of an estate planning technique. So, if you've got maybe a larger estate and you're charitably inclined, what we're saying is if you have a set amount of money you want to leave to a charity when you pass, leave the IRA and let the kids have the more tax preferential assets that get step up in basis and things like that. Another way you can use a charitable trust is actually, remember that stretch IRA where you can stretch the account out over a lifetime? Here's what you do. If you have a big IRA, you create a charitable trust. When you transfer the IRA into the charitable trust at your death, the charitable trust now pays a lifetime of income to your children, effectively stretching out the money over their lifetime, avoiding a tax, okay, on the estate. Kids get a different preferential tax treatment for the income that they receive, and then whatever's remainderment goes to the charity. So rather than pay a huge amount of tax up front to the IRS, here's a way to stretch it over their lifetime as well. Okay? And again, I don't know about you, but does anyone know of people who have children who are not good with money? Okay. Notice I didn't ask if your kids were good with money. That's right. Okay. Using some trust deed IRAs and where you combine trusts and IRAs for some people may make sense, and you might want to look into that so that you have an element of what we call control over what happens with those assets. Okay? Because one of the things I want to keep in mind right here with all this planning I just went over, this is all what we call optional. I can tell you I've been in that situation where I say to a child whose $500,000 is coming to them, they're going to lose 40% of it to taxes, a couple $100,000. Here's a way to avoid that. We can do X, Y, and Z. You'll get this income. We'll spread it out the rest of your life. And they go, oh, Mr. Bohm, thank you so much for that valuable advice. Now give me the check. Okay? And the other thing I'll point out is don't believe your custodian is going to give your children or your family tax advice. They are not. So when your account's at Vanguard and something happens to you and your kids call up, they're basically going to be told, we're so sorry to hear about your dad or your mom. Fill out these forms, send us a death certificate, and we'll send you a check. And everything you've been saving for the last 20, 30, 40 years now becomes taxable all in one day. Okay? Again, these are really a big deal. I really feel like if you think about it, this is kind of a big hit to the middle class because middle class people, the biggest asset they own other than their house, I feel, is their retirement accounts. And the only reason they got away with it was simply because less than 2% of people do this type of planning. And I blame it, the advisory world has to step up because, again, the biggest problem out there is that most financial advisors that people work with, all they look at is the investment side. They don't look at the big picture, okay? All right, a couple other things just to put out there. This is important. In 529 plans, one of the provisions of this act is that you can now take out up to $10,000 from a 529 plan, okay, to make qualified student loan repayments. That's something new. I think that could be really valuable, okay? Also, if you are working as graduate, postgraduate, doctorate, research students, they'll be treated as compensation for purposes contributing to an IRA. So it used to be this income when you did this kind of work, you weren't allowed to use it or consider it in order to make an IRA contribution. You now can do that, which is kind of nice. Also, you can take out $5,000 from a qualified retirement plan for the adoption of a child without the 10% penalty. If you have a husband and wife, they can each take out $5,000 to adopt a child and not pay the 10% penalty as well. Okay? So, again, there's a lot involved. This is kind of a high level of it. There's a lot of devil in the details, but I think it really goes to show, it really calls for some real proactive planning, much more than we've seen in the past, in my opinion. So, and I always remind people, a small mistake with a small amount of money is a small amount of money. But that same small mistake on a lot of money is a lot of money, okay? It's very easy. People don't make mistakes on purpose, okay? But those little mistakes can be very costly. My mother always said, learn from your mistakes. I always found it's much better to learn from other people's mistakes. So we try to help you as our advisor to make sure that we share the mistakes we've seen so you don't make them as well. And that's why, again, when it comes to your finances, you can handle things retroactively, reactively, or proactively. And again, we bring and believe in the proactive approach. And this type of planning calls for it. Okay? With that, I'm going to end. Hopefully this was helpful. Did everyone learn something new? Hopefully you got something out of it. Okay? If you have questions or you'd like additional information, inside your handout, Kristen put a registration and evaluation form that looks like this. If you wouldn't mind taking a minute to fill it out, okay? We really do need it for two reasons. One's actually a regulatory reason. We're required to keep a written record of everyone we've spoken in front of because we can give financial advice. But the second is I went over a number of different things today. If you would like more information on any of these areas or certain pieces, please fill this out. We'll be happy to get you more information. You're welcome to make an appointment. We do a complimentary appointment in our office for anyone who comes to our workshops to sit down on a one-on-one basis and discuss your situation and see if there's anything that we can help you with. There's no cost, there's no fees. Leave your checkbook at home, okay? And then also, you can put down that if you'd like to be on our mailing list, we do an email. We do special reports throughout the year on taxes, estate planning, an economic and market quarterly newsletter. It's very easy to read. It's very understandable. The reports our clients will tell us are really helpful. We can get those out to you as well as being part of our network here. Okay? With that, I want to thank you very much. I really do appreciate your time and attention tonight. Have a wonderful evening. And if you have any questions, we're here for you.